I'm going to move into talking about what's going on in corn and soybean markets and some of the opportunities that might present themselves as we move through this growing season. So first, I'm gonna talk real quick about some of the current market factors, what's kind of going on, what's driving corn and soybean markets. Then I'm going to give a real quick supply and demand update. The WASDE report was released yesterday, and so I've got some updated supply and demand numbers. Then I'm going to talk a little bit about corn pricing and soybean pricing. Obviously, this time of year, we're more concerned with the harvest price, so that December contract for corn or September contract for corn, and then that November contract for soybeans, and then also take a look at what we have in Tennessee in terms of historical basis at a couple of different locations, because that will get us to that cash price that we're potentially looking at given where futures are right now and what our historic basis has been. So just a couple of quick things. I mean, there's been a lot of things going on the last couple of months. I kind of just broke down some of the key factors that are kind of bullish and bearish. So the bullish ones are those that are going to end up supporting prices. The bearish ones are the ones that are going to end up potentially pulling prices back or causing prices to decline. And then there's a bunch of unknown as well. And this is more specific to corn and soybeans. Cotton and wheat are kind of a little bit of a different animal, and a lot of that is driven by weather and where we've seen some dry conditions creep in. So in terms of corn and soybeans bullish, global demand has remained very strong for both corn and soybeans. We've actually seen an uptick in corn exports, where we've actually seen exports get back up, primarily driven by strong demand from Southeast Asia. We've also seen really strong domestic demand, both on the ethanol side and then on the soybean side with the crushing industry. The other one that made a lot of a noise, about a month ago or 2 months ago, was the Argentinian drought. That crop's continued to shrink. So where I seen the estimates today was about 37 million metric tons. So it was almost down 40% from what initial estimates were. That was supportive for soybeans. Another one that's supportive for commodity prices in general has been global economic expansion. Strong economic growth, both domestic and abroad, are generally good for commodity prices. So that's another one that is supportive for prices. On the bearish side, the U.S. dollar rising usually provides some headwinds for exports. We've seen it continually rise over the last 6 months. So the U.S. dollar index, which is kind of a measure of the U.S. dollar against a basket of currencies, is up around that 92, 93, but a pretty strong upward trend. Although the last about week and a half, we've seen it kind of flatten out. Now, I think there's probably still going to be another increase as we end up seeing us move through this summer, where we might get even close to that 96 cents. But I think that if we look at it long term, we'll probably see the U.S. dollar pull back a little bit. Interest rates are part of that. We are expecting another increase this summer for interest rates. That's obviously going to have an impact on the U.S. dollar as well. The other one with corn and soybeans, and again, this is where it's really important to distinguish between corn and soybeans and cotton and wheat, is weather to date. Weather to date in most of the corn growing and soybean growing areas has actually been really good. Under unknown, and this one seems to be changing on maybe even an hourly basis. It depends on what's going on, but trade with China obviously is very important for soybeans and corn, but also NAFTA is an important source of demand. So those things are very fluid situations. There's plenty of information that comes out. Some can be really positive, some can be not so positive. Currency exchange, Brazil, we've seen the Brazilian real depreciate relative to the US dollar. That's another one that obviously creates a competitive advantage for Brazil. Similar things with Argentina as well. Another really unknown is weather moving forward. Right now, forecasts are looking pretty good, but we all know that can change very quickly. So this is I just wanted to throw up the drought monitor. This will be updated tomorrow, but you can see if you look out in winter wheat and then into the panhandle of Texas, where you've got cotton, We've had some pretty dry conditions. We've had a little bit up in the Dakotas where, again, that's going to affect more kind of your spring wheat crop. But if you look through most of the corn belt, so as we go down through the eastern side of the Dakotas into Minnesota and then Iowa and then across Illinois, Indiana, and then down through the Mississippi portal, there really isn't that much in terms of dry weather that's really influenced the crop at this juncture. So if you look at where crop progress, and again, I don't put a ton of weight into crop progress this early in the season. If we all remember back to 2012, we started off the year really well and ended up in one of the worst droughts that we've seen across the major producing regions. But again, it is, I guess it's better to start off well than to start off worse. So again, if you look at 2018, we're right at not quite 80% of the corn crop is classified as good to excellent by USDA. Again, it's tough to put a whole bunch of stock into crop progress this early in the year. We were a little bit behind in planting. If you look down at the bottom of this graphic, with the machine capacity that we have nowadays, we're able to catch up so quickly on that we ended up getting back right up to the 5-year average, right by that kind of middle of May. And then we've ended up seeing the corn crop react as we ended up getting that beneficial weather. If we look at soybeans, very similar set of circumstances, good to excellent, 75%. And again, we've been able to get back above that trend line in terms of planting progress. So again, those are positive in terms of getting the crop in. But again, that does remove a certain aspect of some of the variability, which is going to end up taking prices down a little bit. So again, good conditions usually causes prices to decrease. The other big one, and this one's a little bit more difficult, and I borrowed this from Dr. Mohammed, who is our new trade analyst in our department. But there's a lot of moving things going on right now. In addition to China, there's some of the stuff that happened at the G7 conference up in Quebec, where it doesn't seem like NAFTA, the final negotiations for NAFTA are forthcoming anytime soon. And so again, that could have implications. I'm still optimistic that they will be able to get a deal done, but I think there's a lot of politics involved that might drag this on longer than most of us would like, and it's probably going to end up contributing to additional volatility as some of these statements are made and positions are unwrapped, proposals developed. But when we look at China, it was actually really positive there for a while. They issued a joint statement, this is all within the last 2 weeks, that they were going to put a hold on a lot of the tariffs. Then the U.S. agreed to a deal to lift some of the sanctions on the ZTE, the telecom giant. And then China announced that it was the previously promised cut in tariffs on imported auto parts. And then they scrapped the U.S. sorghum tariffs as well. And then the other one, and this one was one that was actually quite positive. I mean, obviously, trade agreements can work both ways. You can have the negative if people throw up trade barriers or add tariffs. But, it can also result in increased product sales. And when the president tweeted, massive amounts of agriculture product will be flowing to China, that's an important source of demand for our products. They have an extremely large population, and almost equally as important, they have a growing middle class. So, I mean, when you have population and ability to pay for it, they're going to demand products, and particularly as they move into the middle class, they're going to continue to purchase more protein-orientated food state sources instead of grains, and that bodes well for U.S. production. Then, unfortunately, just a couple of days ago, the White House kind of walked that back and said that the $50 billion in tariffs on Chinese goods would be imposed on June 30th. The final list is going to be announced on June 15th. So again, it remains a very fluid situation. It's really difficult to get a handle on which way or what's going to happen from a month-to-month basis. I think a lot of it right now is just posturing. But again, if if both countries kind of really dig in, it could end up being incredibly difficult on agricultural markets. Now, just to kind of quickly look at corn supply and demand. This is the updated WASDE report. I color coded this kind of as yellow is kind of an unknown, green is positive for prices, and then red maybe provides a little bit of concern. And what you'll see is there's a lot of unknown, obviously, in the planted, harvested, and yield. This early in the year, there's a lot that can change there. That June 29th acreage report, I think, is going to be very important for both corn and soybeans. We've seen a big reduction in ending stocks or beginning stocks, which is good. I mean, we've dropped it over almost 200 million bushels. Production is estimated to be down. That's largely a function of acreage and a little bit lower yield. But it'll be interesting to see how those end up changing. Exports were decreased a little bit year over year if you're compared. But if you look at this 2017-18 market year, which is the market year we're in right now, 2.3 billion in exports is up substantially from where we were, 3 years ago. So that can be a positive, although a step back this year would be a little bit detrimental. But a lot of that's going to be linked to what that final supply number is. U.S. ending stocks, this is one that is really positive. You have to kind of take a look at 2017-18 at 2.1 billion is the estimate, where they're projecting for 2018-19 is 1.5. So you're talking about a 500 million bushel reduction. Anytime you contract stocks like that, and you end up maintaining consistent use, you're going to end up seeing prices come up a little bit. And so if you look at the stocks to use ratio, that's kind of adjusting for the use relative to the stocks at 10.79%. That would be the lowest number that we've seen actually since 2010, 2011. So it goes beyond what this table ends up showing. So that I see as a positive, and that's reflected in the year-over-year U.S. average farm price going up potentially 40 cents. Now again, when you're talking the 2018-19 marketing year, that would be the crop that we are going to be harvesting this fall. So again, these numbers are very preliminary, but there are some positive things from a fundamental standpoint happening in corn markets. This is one that I want people to kind of be aware of, just kind of from a marketing standpoint more than anything. And this kind of shows how Brazil has really changed how they produced corn. The Brazilians, they end up doing two different crops. There's a first crop corn and a second crop corn. You can see this runs from 2000 to 2017-18, and you can see there's been a tremendous change going from a first crop production more to a second crop production, where it's almost completely flipped. We've seen increased production, but the percentages have almost completely flipped. And why that's important is if you look at how their crop is, or when their crop is planted and harvested, that first crop, so this is the one that they're moving away from, was typically their peak harvest was kind of March, April. Well, that's kind of the exact opposite of where we're harvesting. If you look at where the second crop is harvested, it's June, July. So think about it in terms of a marketing, why we've seen really strong export demand this time of year. Is largely because this crop continues to shrink while this one expands. So again, there's kind of left a bit of I don't want to say a supply shortfall, because there's always storage, but you don't have that big harvest here. You've got it coming right before we end up hitting our harvest. So again, there's going to be some potential opportunities that might occur, kind of a little bit later, maybe in that in the spring and into the early summer, where you can really take advantage if you've got some commodities stored. But once you start getting into June, July, and they start harvesting that crop down there, you could end up actually seeing, obviously more Brazilian corn hitting the market before ours could eat up some of that demand as well. So, dealing with these types of factors, I think it's important to watch as these shifts are made in production. For the second crop corn, just to kind of clarify what the Brazilians are doing there, is that they plant their soybeans and then they harvest them in January and February, and then they follow the planting with corn So they're double cropping soybeans and then corn on a lot of acreage. And you can see Mato Grosso do Sul, and Parana are kind of the major soybean producing regions. Well, this is where the second crop corn acres are going in. So again, just what I wanted to end up looking at here is kind of, you know, how that has shifted in terms of marking when product is hitting the global market. Because corn prices, yes, the U.S. is still the big dog on the block, but it is really important to look at how our competitors' production is shifting over time so that we can take advantage of potential opportunities. This one I wanted to show real quick. I don't think this is going to shock anybody, but if you look at this, this is the last 5 years of the December futures contract. Where we've seen a large amount of volatility is right in the period we're at right now, that June, July, and into August. That's when we kind of make our corn crop. You can see we've kind of taken a nosedive. I got a better slide on that reduction there. But we have seen some opportunities to end up pricing corn, you know, up over that 450 back in 2016 and 2015. But even last year, we ended up having a little time over $4. Now, obviously, for 2018, which is this red line, we kind of peaked about 2.5 weeks ago, and we've kind of been declining since there. Will we see another opportunity? I think the weather's really going to drive whether we see another opportunity to price corn up that direction. This is kind of just zooms in on the 2018 December contract. We had about a 5-month run up, and then it took 2 weeks to pretty much take that out. So we went from a peak of up at 430 down to where we're at, you know, about 395 right now. So again, I think one of the things, there's going to be weather and then some trade uncertainty. I think we're going to continue to see the volatility because, yes, we've seen this strong uptrend followed by a strong downtrend. But if you look at the volatility in the market, which is basically the height of each one of these individual bars, these are individual trading days, there's a tremendous amount of volatility in there. And a lot of those coincide with some of the trade announcements and some of the speculation that goes on around trade. Now, obviously, that's just on the futures market. What we always want to end up doing is looking at how that translates into cash prices. And to do that, we need to look at monthly average corn basis. So if you look at kind of our harvest period, we start kind of August and go through September, October. You can see that typically when we are harvesting, we're going to be somewhere 10 to 20 under. It depends on the actual crop that's being harvested in Tennessee, but that's something that can be reasonably expected. I think the other thing that this highlights is it does highlight maybe the potential to store the crop and take advantage of some of the higher basis as we move out of this key harvest period. But again, what we want to look, if we have to sell off the combine, is how this basis interacts with the December contract. And so if you take, to get to your cash price, what this chart ends up saying is you take 15 cents off in Memphis, or 17 cents off in Memphis, what the December contract is at that time. One of the things that I always say, I mean, you know, everybody's got a different cost of production, but I think it's really important to evaluate where you are within the growing season. So look at your cost of production and then look at yield and price scenarios that lead to profitable alternatives. So again, I put in an estimate of $550 cost of production. If you're expecting 150 bushels per acre of corn, you can get $4 on the cash side. You're making $50 an acre. I think it's important to take advantage of some of those opportunities. Again, it depends on how aggressive you've been with your early season pricing or your pre-plant pricing. But again, looking for some of these opportunities I think are important. Again, everybody's going to have a different cost of production, but knowing, you know, where you are on an ongoing basis, I think is important. The other thing that I always encourage people to do is to adjust this cost of production. If you have to come in with an extra spray and it's adding to your cost of production, you want to end up accounting for that. It doesn't necessarily guarantee that you're going to see profitable opportunities, but at least you know where you are as you move through that growing season. Switch it up to soybeans. You'll notice there's a heck of a lot more uncertainty in soybeans. Again, we don't really know enough about this upcoming year's crop to really end up saying that it's going to be good or bad. Right now, it's off to a good start, but we do have you know, some a lot of variables that we don't know yet in terms of yield and final harvested acreage. If you look at crushing's been very strong. Exports, again, exports have been really strong, but just with the trade uncertainty, it's really tough to say that that's going to be a positive yet. I think it's a real unknown. It could be an incredible positive, but if things do fall apart in terms of trade negotiations, it could be bad, and that's directly going to influence the ending stocks. Foreign stocks are estimated to kind of move flat to down. Again, the Argentinian crop affected that, but again, South America will be planting another crop this fall, so that's going to be important as well. This is I've used this chart before, but this kind of shows, this is the total percentage of soybean production in the globe. So you can see it's Brazil, United States, and Argentina. Argentina just finished up their crop, but as you can see, a lot of it was very poor due to the drought. U.S. is off to a pretty good growing season, so we've got a lot of favorable crop conditions. They update this on a monthly basis, so I think it's important to know where things are. I mentioned the soybean planting area. You're looking in the Mato Grosso area and then the Parana area. So again, they will start planting in October, November, right when we're finishing up our harvest. So again, that'll shift the focus to South America as we move into the end of this year. I mentioned the importance of China. This is U.S. soybean exports. Again, it's basically about 60% of what we export goes to China. So we do see those trade negotiations take a turn for the negative, or we see a lot of tariffs imposed that could have some implications in soybean markets. Similar to corn, I just want to kind of highlight where we see that large amount of volatility in the November futures contract. And again, it's a little bit later in the year where we see that volatility, but roughly the same time as corn. We have seen a lot more volatility over in terms of magnitude in soybeans, and a lot of that is just driven by the fact that we have basically the two major countries that are competing for market and production. You look at November soybean futures. Again, we've seen a big step back just in the last 2 weeks. We peaked up at 1060. Got pretty high. I've been talking about anything north of $10 was a pretty good pricing opportunity, and it kept going up, but we've seen it come down real quick. So I hope people were able to take advantage of those pricing opportunities, because when you see a 95-cent decline in 2+ weeks, I'm not saying that we can't get back up here, but it's going to take some real positive news in terms of trade or a drought, which you never want to wish a drought on anybody, but again, making up that 95 cents is going to be something that's going to be potentially a little tricky. Switch up to Tennessee soybean basis. Again, we've got the Northwest and then the lower middle. You can see we turn negative, and once we enter September, October, and November, so anywhere between 25 or 27 cents under the November contract in the Northwest. Lower middle, down around 20 cents. Again, it's going to be dependent on how this crop progresses, but this is what our historic average has been from 2013 to 2017. Again, highlighting those net returns. This is a $415 cost of production, so you'd have to adjust that. You want to make sure that you do put in all your production costs, including your land and a return to management. But where the current market is offering right now, if you're going to get a 50 bushel yield, and if your cost of production is $415, you can end up getting a little bit of profit, $48 to $73 per acre. But again, you have to make sure that this cost of production number. And I think that's one of the real keys that I'd like to kind of hammer home, is knowing that cost of production, both from a farm management standpoint, but also from a marketing standpoint. I mean, it's really tough to make a sales decision if you don't know if you're making or losing money. So again, you can see if you have different yield expectations, different price expectations, where do you make money, where do you lose money? There's not always going to be a profitable option, but knowing is a really big part of developing a solid marketing plan. So what now? After we've seen kind of commodity or corn and soybean prices come down substantially, I would advise probably not to make a hasty decision. Avoid the emotions of the market. Now's not the time to rush into the market. I think if you did end up getting some of your pricing done earlier in the season, I think it's time to stay the course. stick with your marketing plan. You know, you have crop insurance, some type of forward pricing, hopefully that has ended up occurring, whether that's a hedge or whether it's just a cash forward contract, options, any of those things can be classified in the forward pricing. Look at what your percentage of harvest sales is going to end up being. Again, you kind of have to adjust that as we progress through the growing season and you know more about what your individual field production is going to end up being. And then evaluate your storage options so that you can take advantage of some of the beneficial basis opportunities that are out there. I mean, this is applicable for most of Tennessee, but especially down in that lower middle Tennessee area or areas where we have really strong livestock. We can end up seeing some really positive basis opportunities if you have the ability to store the crop. I mentioned know your cost of production. You know, I really am a strong believer about doing cost of production numbers on a field by field basis because there's a tremendous amount of variability in some of the land that we farm in terms of production potential, but also on the cost side of things. So knowing which fields are making you money and which are losing your money, I think is really important. And then know your basis. From a report standpoint, the next big one is the June 29th acreage report, and it could provide some fireworks. So, you know, keep that date on your radar, and then evaluate those opportunities should they present themselves. So if we do get some dry weather that creeps into the corn belt and we do see corn and soybeans come back up, you know, take a look at where you are in terms of your pricing and maybe see if you want to end up adding a little bit more at that time. Right now, I'd probably hold off just because we have seen a dramatic correction. So again, I don't think now's the time to panic, kind of stay the course and look for those opportunities as we move through this year. Here's my email address if you have questions, and then we'll post this to the Crop Economics webpage.